Investing is a long-term game that will build wealth over time, which more often than not requires investing regularly. Experts agree that putting money away on a regular basis over time has the ability to make average people wealthy, but that timing the market is a loser's game. Dollar cost averaging is a strategy that most investors employ, with many of them not even realizing it, all while reaping the rewards of it. If you were to receive a large inheritance or money from a lottery win, should you dump all that money into the stock market in one day, or would it make more sense to break the chunk up into smaller amounts and invest a certain amount regularly over time? When experts are predicting recession in the near term, should you hoard cash and wait on the sidelines until something happens, attempting to time the market to increase profitability? What is dollar cost averaging and how can it benefit you? If you enjoy videos about money, personal finance and investing, all topics that will help you better your financial future, consider subscribing to the channel and hit the notification icon to be notified of new videos. If this video is helpful, make sure to hit the like button. Dollar cost averaging requires a regular contribution, often from a paycheck, that is allocated to your retirement or investment account on a fixed schedule, perhaps every week, bi-weekly, or monthly. Others may choose to do the transfer manually due to the fact that they're self-employed or their employer might not offer investment services. This method can work as well but requires more time, thought, and effort, which isn't always a good thing. This is especially less desirable for people who tend to get nervous as the market fluctuates. Market fluctuations are normal, so taking emotions out of the equation by using an automatic investment strategy can be beneficial. If you invest in a 401k, chances are you're implementing this strategy of dollar cost averaging. It's said to be the safest investing strategy that's likely to return you the most money over time. Dollar cost averaging entails investing a fixed dollar amount of money in the same stock or fund over time. In other words, the same dollar amount of an investment will be purchased on a regular basis, regardless of the asset's price. This might mean buying the same share monthly or weekly or on any fixed schedule. If you contribute the same amount from your paycheck on a regular basis through your 401k plan, you are taking advantage of this. Say you have an IRA that you contribute to every week. The money is taken right out of your bank account and automatically invested in an S&P 500 fund, for example. You're already taking advantage of this investing strategy by making purchases of the fund with a fixed dollar amount on a fixed schedule, even as the price of the S&P 500 goes up and down. Most people who use this strategy really don't care what the price per share of an S&P 500 fund is at any given time, as long as their money is there when they retire. This is a fantastic investment strategy for everyday investors because it allows them to profit from market dips by purchasing more shares when the price is lower, without the nerves that some investors often have when they see the value of their investments dip. Using this strategy couldn't be simpler. Anyone with a proper investment account can take advantage of this technique. Some people have their accounts set up to automatically invest the money in the vehicle of choice when the money is deposited based on a predetermined schedule. This is the easiest way to use this method as it requires absolutely no work or effort. Other investors choose not to use automation, which will require them to manually purchase shares on a regular basis. Doing this the manual way is more complicated because it requires time to make the purchases, and emotions are more likely to be affected by market fluctuations. Whether the purchases are automated or not, the same dollar amount of shares are purchased. For example, invest $100 in the same stock every week. One week the stock might be priced at $10, which will allow you to purchase 10 shares. The next week the stock could be priced at $20, which would only allow you to purchase 5 shares. Or the price could drop to $5 per share, which would allow you to take advantage of a sale opportunity and purchase 20 shares. The number of shares purchased each time will vary based on the price of the stock or fund at the time of investment. Ignore any market fluctuations, even if the economy collapses and other investors are fearful and selling everything they own. When the share price rises, your money buys fewer shares. When the share price drops, your money buys more shares. Automating this will reduce the likelihood of panic when recession and turmoil are constant news headlines. The problem is that many small investors get scared when the market gets volatile and sell off at the worst time possible, and then just start getting back in when things are looking toppy again. This is a common mistake that we see during every recession. While the little people are panicking, The large, institutional investors are profiting tremendously and using bargain basement prices on investments to their advantage. Warren Buffett has said that he made a large percentage of his fortune by taking advantage of discounted investments during the Great Recession and waiting for their prices to recover. By employing a dollar cost averaging strategy over a long period of time, the emotion is left out of the game, giving you the ability to make money during times of turmoil as well as the boom times. As simple as this method is, it's a very effective and strategic way to invest. As you buy more shares when the market is down, the average cost per share is reduced over time. This method is particularly useful for new investors who are just getting started out and are looking to add to their position. Say you just received a large windfall of $100,000. Would it be wise to invest the entire sum in the stock market on a single day, or would it make more sense to buy $10,000 worth of shares over a few months' time? Investing the money over time is less risky because it's impossible to know what the markets are going to do next. It's clear that investors have no idea how to predict the future of stock. Just look at some investment news articles and you'll see so-called experts with wildly different predictions on when the next recession is going to occur. Some say there isn't one in sight, and others predicted that there was going to be one 5 years ago. Stocks could drop due to looming turmoil, or they could rise abruptly due to positive economic news. By dollar cost averaging, you're essentially diversifying the price at which the investments are purchased, ultimately lowering your risk. Employing this investing strategy takes the emotions out of the game, which tend to run unusually high when the market is either doing very poorly or hitting all-time highs. Investing the same amount of money every week will allow you to worry about other things that are perhaps more beneficial, like your budget, family, and career. For most people, they're better off financially worrying about how to optimize their time, productivity, and income during their hours at work and investing automatically. We've seen it happen before. When there's a disruption in the stock market and prices start falling, small mom-and-pop investors often panic. They stop putting money towards their investments and sometimes sell everything. Then when the market turns and finally recovers, these people gain confidence once again to start contributing to these accounts. But the majority of the profit has already been made by this time. If you set up an automatic contribution to your investments on a regular basis and set it and forget it, so to speak, you can keep your portfolio on the back burner while you go about your everyday life. For example, assume an investor deposits $1,000 on the first of each month into index fund XYZ, beginning in January. Like any investment, this fund bounces around in price from month to month. The investor keeps steadily putting $1,000 into the fund on the first of each month, while the number of shares the amount of money buys varies. In January, $1,000 bought 50 shares. In February, it bought 62.5 shares. In March, it bought 83.3 shares. In April, it was 58.2 shares, and in May, it was 43.48 shares. Just 5 months after beginning to contribute to the fund, the investor owns 298.14 shares of the index. The investment of $5,000 has turned into $6,857. The average price of those shares is $16.77. Based on the current price of the shares, the investment of $5,000 has turned into $6,857. If the investor had spent the entire $5,000 at once at any given time during this period, the total profit might be higher or lower. But by staggering the purchases, the risk of the investment has been greatly reduced. If the investor purchased all shares on one day, he might have gotten lucky if the share price was low. But he also could have been unlucky and bought on a day when the shares were very expensive. Using this strategy isn't guaranteed to provide you with the best return. If instead an investor decided to invest a lump sum all at once, they could get lucky and buy at a market's bottom. However, it's also likely that their purchase could be made at all-time highs, limiting returns. Your potential risk is reduced when making smaller purchases over a long period of time. Timing the market rarely works. Even professional mutual fund managers have a difficult time outperforming the benchmark, which is why it makes sense for individuals to employ this proven strategy. Not only could your returns be higher, you'll benefit from reduced risk as well. Additionally, dollar cost averaging is perhaps the easiest investing strategy you could possibly use. Don't be fooled thinking you can limit losses by selling your investments when you think the market is headed down. Instead, keep investing the same dollar amount regularly and enjoy lower priced investments, and then simply purchase fewer shares of the same dollar amount when the assets are more expensive. This strategy has worked for millions in their 401k accounts, so it could work for you too.